Welcome. As we approach the end of the year and contemplate our last-minute year-end moves, I thought it might be a good idea to bring up one of the most overlooked tax strategies. That tax strategy is the Qualified Charitable Distribution, or QCD. What are the benefits of a QCD? QCDs were established to enable IRA account holders to satisfy their requirement of distribution withdrawals. Because the funds are distributed to a qualified charity, the distribution would not be reported as taxable income to the IRA account holder. How do QCDs work? If you or someone you know is over age 70 and charitably inclined, they can direct the custodian of their IRA to pay a distribution check or checks to their favorite charity or charities. The money cannot be paid to the IRA account holder, but the custodian can make the check payable to your charity and mail it to you for forwarding to the charity. The 70.5 age requirement was established to coincide with the requirement of distribution that IRA account holders are required to make. But although the RMD requirement now has been pushed back to age 72, the minimum age to make a QCD remains at 70.5. So why are QCDs particularly beneficial now? Well, many filers no longer itemize on their tax return due to the substantial increase in the standard deduction under the current law. Therefore, they did not get a tax deduction for their charitable contributions in 2018 and 19. In 2020 and 2021, as a response to the pandemic, the CARES Act provided a small tax deduction. Since qualified charitable distributions are not included in your taxable income, it's like getting above-the-line tax deduction. Additionally, since the amount of your Medicare premiums is based on your modified adjusted gross income, using QCDs can help prevent future increases in those premiums. Also, if the amount of your QCD is more than your RMD amount, like it was in 2020 when the CARES Act eliminated the RMD requirement for that year, then you're effectively reducing the amount of future RMDs, which are calculated each year based on the level of your assets in your IRA as of the last day of the year. This can help save on future taxes and help keep Medicare premiums low. Can QCDs help with estate planning? Yes. From an estate planning perspective, retirement accounts are like ticking time bombs. This is more evident with the passing of the Secure Act. In general, inherited retirement accounts must be emptied within 10 years for non-spousal beneficiaries, which will be synchronized with Uncle Sam and his estate cohort dropping by for a visit. It is generally better to pass on non-retirement plan assets to loved ones rather than retirement accounts, Roth IRAs excluded. This is because there's typically no tax associated with them due to the presumption that the assets have already been taxed, or a step-up in basis may be available. So if the assets were to be sold, any potential capital gains would be eliminated or at least minimized. So, if you are not 70.5, but you have the opportunity to share this information with a relative, they might look favorably upon you when they pass on. It could be a win-win. They save on current taxes, and you save on future taxes. And even if you don't stand to inherit, I'm confident that your name will be held in high regard around the bridge table or the pickleball court. Thank you for watching, and remember to like us on Facebook, follow us on LinkedIn, or subscribe on YouTube.